Welcome. My name is Lee Pinkowitz. I'm a finance professor and associate director for student engagement at the Pissarro Center for Financial Markets. We're really happy to have Erin here for this final Step Up seminar series of the spring. And actually, it's bringing it full circle, beginning that we started this winter with a fully virtual seminar, and I guess ending with a fully virtual seminar. It seems somewhat fitting. But really, the credit here goes to GIF, to Dan and Will and Jack for sort of setting this up. And so I'm going to just turn it over to Dan now.
Awesome. Thank you, Professor Pinkowitz, and welcome, Erin. And thank you, everybody on the call. We have a good little audience here today, and hopefully it'll be a fruitful discussion. Before we kick things off, I'll give a little background on you, Erin, and then we'll kick it over to you. So without further ado, let's kind of get started. So again, welcome everybody. Erin is joining us. She's a managing director and portfolio manager focusing on asset allocation strategies at PIMCO, including PIMCO's multi-asset funds and target date offerings. She manages multi-asset strategies, leads the Glide Path leadership team, and has served as a rotating member of the investment committee. Prior to joining PIMCO in 2018, Erin was a managing director and head of asset allocation at UBS Asset Management, helping to drive the firm's macro research, capital markets assumptions, tactical asset allocation, and strategic asset allocation views across asset classes. At UBS, she was also head of macro investments at UBS O'Connor, a multi-strategy hedge fund. Previously, she was a global macro portfolio manager at Point72 and has also held roles at Citigroup, Moore Capital Management, Neuberger Berman, Lehman Brothers, and she regularly appears on CNBC, Bloomberg Television, and other financial news media. On top of all of that, Erin was named to Barron's 100 Most Influential Women in U.S. Finance in 2020. And outside of portfolio management, she's heavily involved in impact and nonprofit space, having recently joined the board of the Ocean Conservancy here in DC, in addition to her positions as the board treasurer of the Ecology Center and advisory board member of Girls Who Invest. She has 20 years of investing experience and holds a bachelor's degree in economics from this fine university, Georgetown University. So welcome, Erin. I wish you were in person. We could give you a nice round of applause, but we are so thrilled you decided to join us today. So thank you.
Thank you guys all for having me. I'm excited to be at least virtually back at Georgetown. My husband and I both are Georgetown grads. He graduated from the McDonough School of Business undergrad back in the day, and I obviously from the college, but I'm really excited to at least virtually meet all of you today.
Cool, thank you very much. So let's kick it off. I know everybody wants to talk macro here and hear a little bit about your journey, but let's start with your journey. I know it wasn't a traditional path, although you've spent some time on Wall Street. Tell us how you started at Georgetown and how you kind of made it to PIMCO.
Sure, absolutely. So I started in the college actually as a pre-med student, and really had sort of geared myself, prior to Georgetown to go into pre-med. My entire family are doctors or in the sort of medical field. And really, I think it was my sophomore year at Georgetown, I took a class in macroeconomics and just absolutely fell in love. I had really never considered economics or finance as a career, prior to that, but really just loved, sort of both the practical, but also sort of the more quantitative aspects of economics, and felt like that was something that I really wanted to do with my career. Didn't really know what to make of it, but had started interviewing, I guess, during my junior summer for internships across Wall Street. And, I think I initially thought coming out of undergraduate that I would do, a couple of years in banking and then go back and get a PhD in economics and work at the World Bank or the IMF, and sort of had these lofty aspirations for that. But through my sort of journey on Wall Street and working at Lehman Brothers directly after Georgetown, I really fell in love with Wall Street. I loved the dynamicism, the fact that things were constantly changing, constantly moving. It was exciting every single day that I came into the office. There were, new markets that we were evaluating, and sort of I could practically apply macroeconomics to, which was my field of study and which really initially brought me to finance. to what I was doing on an everyday basis, which is sort of how I ended up, I guess, as a macro investor. So, while my path, I guess, from undergrad to finance was a little bit circuitous and certainly not direct. I didn't go into Georgetown thinking that I was going to come out as a economics major, let alone go into finance. My path since has been, fairly straightforward. I spent 3 years in investment banking, then moved over to, the wholly owned mutual fund company at the time of Lehman Brothers, which was Neuberger Berman. Spent some time there and then jumped over into macro investing and have been doing macro investing since my days at More Capital, which was, almost 20 years, I guess 18 years ago. So, I've, been, sort of a macro research analyst, then a macro investor, and now a macro portfolio manager managing our asset allocation suite of products and our target date funds. But, it's really my love of macroeconomics, which first brought me to finance.
Awesome, thank you. And maybe for some of the people not on the call that may not know what macro investing is,
Sure.
Could you provide some color on what that is and why you get so excited about it?
Sure. So this is my pitch for why everyone should be a macro investor. I say that's somewhat in jest, but it's macro investing is very opportunistic. We don't have limitations in terms of the sectors we cover, the asset classes we trade, the regions or the countries that we invest in. We invest across, following macro fundamentals and inflection points in the macro economy and in terms of driving our investment decision making. So whether that is in equities, whether it's in FX rates or credit, I invest across the entire, sort of stack of investable asset classes, but do it on a top-down basis. So really evaluating different economies, different, inflection points in economies to really determine how I'm investing across asset classes, and then really look opportunistically for what the best expression of that investment could be. So as an example, if we see inflation starting to rise in Brazil, as an example, which happened last year, and starting to outpace what the central bank's expectations for inflation should or ought to be, there's a lot of different ways that you could express that trade. Now, naturally, you would expect that the central bank would start to raise rates or tighten rates in sort of, in response to rising inflation. And so you would expect, as a result of that initially duration would sell off in Brazil. So you would want to, sort of pay rates in Brazil in response to that, until you assess that inflation has gotten under control, at which point you would probably, flip the other way and want to start to receive rates. And there's, different ways that you can express that through the fixed income markets, also through the FX markets, or even through equities, in response to rising rates. You may not want to be long Brazilian consumer sector, but you might want to be, long Brazilian financials, for example. So really looking at investing from a top-down basis as opposed to a bottoms-up basis where you're stock picking and really analyzing the corporate fundamentals of an individual company or a sector of equities, and investing along those lines. So the really cool thing is that instead of speaking to corporate management, I'm speaking to the heads of central banks or the finance ministers of different different countries, to get a handle on sort of what the economy outlook is and where those inflection points are across the globe.
If I can just chime in, it's Lee, Erin.
Yeah.
We had Jason Trenner from Strategis Research a couple weeks ago, and he was talking about macro, and what he actually said was his view of Wall Street was that everybody thinks macro doesn't matter until it does. And I'm just curious if you would agree with that sentiment, and is it, because it would seem like now it does, but
Yeah.
have you seen it sort of more of a push towards people either looking at it or asking you or focusing on it?
Okay, so I may ruffle some feathers here, but I actually started at Neuberger Berman as a tech analyst, so very bottoms up. tech analyst evaluating semiconductor companies and IT service companies. So like Infosys, IBM, sort of more service oriented companies, as well as hardware companies. And that was sort of a natural progression from investment banking, where it's very focused on corporate fundamentals. You move into the buy side, and I moved into a very value oriented shop that was very focused on bottoms up stock picking. And what I realized launching on the IT service companies while at Neuberger was that while the corporate fundamentals mattered for about 15% of the stock movement, 85% of the stock movement was really driven by the macro environment or the macro regime that we were in. Was tech in favor, out of favor? Were people buying growth stocks, or were they buying value stocks? Were they, looking at stocks with heavy international exposure, or did they want more domestically oriented stocks? Those are all macro decision making, or all macro decisions, all sort of viewed through a macro lens. And what I realized was that, at least for me, while relative value trading and gains could be had on a sort of individual stock picking basis, a lot of the beta was determined not by individual stocks, not by the micro, but really by the macro. So for me as a investor, managing a portfolio, what I really cared about was in many cases was, sort of beta in the market, and where, and what the sort of environment was for beta across different risk factors in the market. And that those decisions were largely macro. So, I do think that, macro sort of ebbs and flows in terms of its relevance in markets. Certainly over the last 10 years, investors of all ilk, whether you're a macro or a micro investor, had to care about, the macro, because they cared about what the Fed was doing. They cared about what fiscal decision makers were doing. And that was large drivers. Geopolitics and monetary policy have been large drivers of the market, certainly over the last decade post the global financial crisis. But I don't think that macro ever goes away as a primary input or a primary driver into decision making for portfolio construction. I think it really is the foundation for portfolio construction. Now, I say this with a heavy bias as a macro investor. That said, I've done both sides on the micro side as well as the macro side, although the majority of my career has clearly been on macro.
Speaking for the Graduate Investment Fund, that's music to our ears. I think as we've been managing through this very difficult time from a macro perspective, the top-down view has been instrumental in our outperformance so far and the moves that we've made to kind of protect ourselves as we look forward. So let's dive into portfolio management a little bit more and kind of your role at PIMCO. Can you explain to the group maybe, just some of the fundamentals of what you do and what you specialize in asset allocation? What is that and why is it so important?
So I think about asset allocation as if you think about portfolio construction or even managing a portfolio, whether you're a wealthy family office, a insurance company, a sovereign wealth fund, or an individual investor, you're really thinking about, when you're thinking about managing your pool of assets, you're thinking about, how do I want to allocate those assets across asset classes? How am I going to get the best risk managed return for my portfolio over time? And different investors have different definitions of what appropriate risk is and appropriate return is, and they have different definitions for how they measure those returns and over what time period that they measure those returns. But as a starting point, that's really what you care about as an investor. Asset allocation, I think, really sits at the center of that. And I think that really drives, or should drive, the core of the portfolio. And then around that, you will add, sort of different add-ons or different sort of spokes to that sort of hub and spoke approach that I sort of liken asset allocation to, where the asset allocation is the hub, and then you have different spokes around that to drive alpha during different market regimes. So as an example, your core asset allocation portfolio is that sort of what really sits at the bulk of your portfolio decision making, and that can be anywhere from from 25 to 80% of your core assets. And then on top of that, you add add-ons like infrastructure funds, like private equity funds, like hedge funds, like, long short funds or value funds, and to really round out the entirety of your investment portfolio. And that will sort of formulate, based on the investor's own views in terms of, how they want to construct their portfolio, whether they want more private equity or hedge fund assets, illiquid assets, or they want, pure liquid assets, whether they want, downside risk protection, where you would, potentially buy contrarian funds as an example, or you want more diversification, and where you might want to invest in long short equity, or you might want to invest in other sort of liquid forms, or liquid alt forms of sort of relative value returns in order to sort of diversify your book more appropriately. So many people think about asset allocation as 60-40 funds, which means that you're 60% invested in equities and 40% invested in bonds. And that over time has delivered, at least over the last 2 decades, really over the last 30 years, about a 10% annualized return, because your downside sort of risk protection of fixed income sort of absorbs the risk when risk trades off, and provides you with some type of diversification of return. And then equity sort of provides the upside. So that's why you're sort of 60% equities, 40% bonds. Over time, that's proven to be a resilient model. And even last year, 60-40 funds delivered about 10% in terms of the total return to the investor. So it's proven well, despite the fact that interest rates have been exceptionally low. Over time, we've seen, and certainly over the last couple of years, just given the ultra low level of yields, we've seen asset allocation funds gravitating, particularly on the institutional side, to 80-20, where 80% of your returns are equities, 20% of your returns are bonds. And some that are more conservative, particularly in Europe, have moved to the opposite way, to 50-50, which is 50% equities, 50% bonds. But that's sort of the plain vanilla asset allocation fund is 60% equities, 40% bonds. There also has been an evolution where investors, particularly institutional investors, are looking for outcome-oriented asset allocation funds, which means they want 6% returns every single year. Don't care what the asset, what your mix is, but will give us money and expect that we'll choose the ideal asset allocation or the optimal asset allocation in order to get them 6% or 7% or 8% returns over time. Usually with a vol that is sort of double what the return is. So, sort of targeting a 50.5 Sharpe ratio. But so if in simple terms, if your expected return is 6%, then you would manage to a 10 to 12% volatility. So you would get anywhere from a 0.5 to a 0.7 Sharpe ratio. But that's sort of the two sort of ilks of asset allocation. Either you're managing to a something like a 60-40 fund, with potential higher or lower equity returns, or you're managing to a absolute return number or an outcome oriented return that is decided by the client. I don't know if that answered your question, but that's
no, it totally did.
Is. Okay.
Yeah, I think it was a great overview of what asset allocation is. And we have Maz here from our macro fund in the graduate program with a question for you, Erin.
Sure.
Go ahead, Maz.
Thanks so much, Dan. Yeah, thanks, Erin, for coming out to speak with us. As Dan mentioned, I'm the president of the macro fund here at McDonough, and we've definitely been having thoughts like that. We're very fixed income focused, and as we're in a hawkish environment, it's a fun time to be looking at fixed income. But on your point about the 60-40 fund, do you feel, you've mentioned that there's still, we've still been seeing that 10% return, so it's still running strong, but do you feel like investor sentiment is changing around the 60-40 fund, considering that as bond prices and stock prices or equity prices start to move in tandem, foreign FX fixed income is seen as less of a hedge towards equity movements?
Yeah, and I actually published an article about this in the FT last year, because
Wow.
pretty much every year I've woken up at the start of the year, January, there's an article in my Bloomberg that says 60/40 is dead and sort of proclaims the death of the 60/40 fund. And yet time and time again, over the last 5-10 years, really over the last 30 years, 60/40 has proven not to be dead. We've had bouts of correlation spikes, where bonds and equities have been more, correlated to one another. And certainly, even if you look over the last, 10 years, the correlation has become less negatively correlated, particularly over the last 2 years, between stocks and bonds than it has been in the past. But we still are in a regime, depending on how you measure correlation, where stock bond correlation is negative. And what I think is particularly important is that what you see from fixed income is that during bouts of extreme risk aversion, like we saw during the pandemic, stock and bonds, performed quite sort of negatively correlated with one another, and bonds did provide that risk offset to equity funds, as you would expect. Even in countries like Germany, where the starting point for yields were quite negative going into the pandemic, they became even more negative at the sort of peak crisis of the pandemic. And so bonds still do perform in tail events, quite, nice diversification and sort of correlation benefits for equity funds. Now, during a more normalized environment, where risks aren't so extreme and we're not, trading at the tails, there have been decreasing benefits from diversification from fixed income. And so that's why I think that if you're just investing in plain vanilla, sort of fixed income like treasuries, or, the Barclays Ag, you're not going to get the same benefits from fixed income as you have in the past because of the low levels, sort of yields. Now, with the backup of yields today at almost close to 3%, they're starting to become attractive again. And we actually have been hearing from some of our sovereign wealth clients and our pension and insurance clients in recent weeks that they're starting to sort of nibble again at yields as they get close to that 3% handle on the 10-year. But still, I think that if you look at the forward expectations of bonds in terms of what your total expected return can be for bonds over the next 10 years, your starting point of that yield level today is a pretty good indicator of what you could expect to get from bonds over the next 10 years. And so what that basically is saying is that over the next 10 years, we could expect, sort of a return of about 3% from fixed income, US fixed income, which is not great, or from the Barclays Ag, which again is not great. So what I think that means is that as a fixed income investor, you really have to look at alternative sources of duration in order to be able to expect a better return than 3%. So whether that's looking at emerging market bonds, at high yield bonds, at securitized assets that can provide some duration to your portfolio, you really have to sort of expand beyond a very narrow duration sort of lens in order to be able to pick up incremental yield at still decent risk, it's still decent sort of risk levels. And so right now, we think that some parts of the credit market look attractive, particularly the more liquid parts of the credit. So CDX looks attractive. We think that like some of the COVID recovery names, like travel and leisure bonds, airline bonds, that have good covenants and have good balance sheets, we think look attractive, particularly in the double B, triple B, sort of segment of the market. So sort of the rising stars, so in the high yield market, we think look attractive, but you can't just rely on plain vanilla duration in order to be able to provide, any decent return over the next 10 years, to your portfolio. So I think it means just focusing on diversification and expanding the lens that you're looking at duration through, rather than giving up on 60/40, completely.
Absolutely. Thank you so much.
Awesome. Yeah, I'd love to dive into that a little bit, but I do want to kind of shift gears a bit and take a step back because there is some interest in investment grade now. I think, Erin, I heard that today. There was a stat thrown out at UBS today. Morgan Stanley issued a note at, I think it was 2 billion, 5.2%, which the same structure in November or October of last year was 2% coupon. So, people are definitely starting to ask about that and get interested again. But from your perspective, and as you entered into 2022, what have you done differently, if anything, to help preserve, your investors' returns or protect against this, what I would consider a high risk environment that we're experiencing?
Yeah, I think the one thing that we did well and got right starting at last year was really honing in on the supply disruptions and the impact that was going to have to inflation. And so providing inflation protection to the portfolio, particularly as we moved later cycle, which our proprietary macro models were suggesting that we were really rapidly moving into a late cycle regime, really helped us position across inflation protection in the portfolio. So we did this predominantly last year through buying REITs, which were up 40% last year. And so, sort of delivered a nice return to the portfolio. And we sort of transitioned that at the feeling that some of the REIT valuations were quite rich as we exited the year of 2021. We moved into more metals, mining, energy, more sort of real commodity exposure in our portfolio, both by buying the outright commodity futures, as well as by buying companies that were really leveraged, equity companies that were leveraged to commodity inflation. So metals, mining sector, both here in the US as well as abroad. And particularly those metals and mining companies that were more secular in nature because they were really leveraged to ESG. So copper companies, as an example, and aluminum companies that we thought had, sort of longer life cycles than the immediate inflation that we were facing, both here in the US as well as abroad. So I think that, particularly as you move later cycle, that 60-40 that I discussed, can also be thought of as maybe a 60-20-20, where it's 60% equities, 20% fixed income, 20% commodity, or at least inflation protection in your portfolio. And that's how we've thought about constructing our portfolio this year.
Awesome. Yeah, the fact that you did some of those moves ahead of this year is admirable. I think a lot of people did not and were caught a little off guard. And I was going to ask you, my next question was going to be, how has your portfolio shifted from something like 60-40 this year? But you answered that question as well.
I will say we did not foresee Russia at all. Like that was a complete surprise to us, but we did foresee inflation for very different reasons, which is why we shifted our portfolio.
Yeah, there was chatter about it in the fall, right? People were talking about it. So it wasn't something that was a surprise like Russia for sure. So you mentioned ESG and, I know your involvement in some of those nonprofits, but can you talk about ESG and the methodology that you guys apply at PIMCO, if any, and how that factors into the way that you construct portfolios? Because similarly, as we operate our funds here at Georgetown, we have to abide by some ESG standards and a socially responsible investing policy. So I'd like to hear how you make those considerations.
So I think this is one of the number one, or at least the top 3 secular trends that we as an investor, will face in the future. And it's something that's really in its nascency in the US today. While a lot of people talk about ESG, I don't think many people invest across ESG as thoroughly or systematically as they will in the future. But it is something that I think is very relevant to European investors, and where every single RFP or request for proposal that we get from a new institutional client out of Europe really does ask us in detail to delineate how we think about ESG within our portfolios. And we are migrating, or in the process of migrating, many of our funds across PIMCO to be compliant in a very stringent sense to ESG principles. And I expect that over the next 5 years, you would expect that all of PIMCO's funds would be would have an ESG. You can invest in the non-ESG or the ESG fund at PIMCO. Many funds will just be ESG funds that are offered, because you sort of want to manage to the toughest or the most stringent denominator, and it just makes portfolio management easier if you only have to manage one fund as opposed to managing sort of two different flavors of the same fund. So it is something that we have developed internally, very strict guidelines on, and continue to refine and enhance those developments. And we have a team at PIMCO that is entirely dedicated to ESG, and making sure that any funds within PIMCO that market themselves as ESG funds are marketing themselves and are following the protocols that we've set forth as a firm. So the way that we do this is a couple of different angles, but on a very basic level, every single credit analyst, and we have about 70 credit analysts at PIMCO that evaluate corporates, have to assign our own proprietary ESG score to the corporates that they or the management companies and the corporates that they follow or that they cover. So if you're talking to IBM as a credit analyst at PIMCO, we have a list of questions and a list of sort of protocols that you have to follow as a credit analyst in order to assess the ESG score for IBM as a corporate issuer. And that follows environmental, social, as well as governance, sort of requirements that we have developed internally as a firm. We tend to be more strict than the MSCI definition or the Morningstar definitions of ESG weightings. So while we look at Morningstar and MSCI ESG weightings, we tend to have a little bit stricter of a definition and protocols that we follow. But it's, we feel very comfortable with the sort of proprietary weighting system that we've developed here at PIMCO, and feel like not only does it deliver what our clients want, but more importantly, or equally importantly, it also, we think, delivers a better corporate long-term values to investors that ultimately align with better returns as well. And so we see, ESG as not just, sort of check marks that you check a box on, but we actually think that it delivers better returns over the long term. Because if you have a company that's focused on governance, that's focused on social responsibility, that's focused on environmental responsibility, over time, it means less litigation risk. It means, better or happier employees. And it means, you're not running afoul of litigation or risks that, could expose the company unduly to and the investor unduly to risks within the company. We are now in the process of developing technology here at PIMCO, so that when you're constructing your portfolio, you can optimize that portfolio very easily across those ESG scores and those ESG weights. And it will inform portfolio managers of the different sort of ESG scorecards according to PIMCO's PIMCO systems that it's developed, so that you can align the risks of your portfolio with the ESG score with sort of optimization of that portfolio. And so we're sort of in the process of rolling that out right now across the different portfolios at PIMCO. So we have a very sort of I think very, very advanced way of investing across ESG. It's something that we've been doing for over 20 years. But clearly with it gaining steam and with the use of technology, we've been able to refine those capabilities significantly.
Right. That's awesome to hear. I think there is definitely a divide in companies that do it and consciously understand that it will produce returns over the long term. And then there's unfortunately companies out there that are obviously doing it to check the box. Right. And I think the problem, particularly with US issuers to date, is that they haven't really been penalized yet outside of the energy companies and maybe the tobacco companies for ESG. But I think that that's changing and that's shifting, and particularly as younger investors become older investors with more capital at their disposal to really make those allocation decisions, we're going to see this
come front and center for corporates, I think, over the coming decades, and be something that, corporates aren't going to be able to get away with anymore.
Got it. Professor Pinkowitz, go away.
Yes, I just had about ESG because I'm older, right? Do you find, Erin, with like your clients are really, everybody's more focusing on the E part of this, because, governance, back in the 80s and 90s was a huge push, right? And now we've sort of seen it going the other way, right? High-tech firms have dual class shares. Twitter is going to launch a poison pill, right? I mean, I guess diversity of boards, we could say that has been a push, that's so, but everybody says ESG. Is it really much more the environmental and social parts, though?
You're 100% right, and this is something that I bring up regularly. It's that when we talk about ESG, we're really just talking about the E. When companies are being measured on ESG, they're being measured on their environmental scores largely, and there was some push over the last 2 years on the S, and certainly you bring up diversity of boards. There's certainly been a push on diversity of boards, but outside of that, it seems largely lip service. The question and the discussion has been, certainly with, the political events in the US and abroad over the last couple of years, and some of the, social push on governments over the last couple of years, whether or not we'd start to see that really percolate and show up in, corporate governance and corporate responsibility. But we're still in very early days of seeing S or G become as prominent as the E in ESG.
Definitely, 100%. And I kind of want to transition into some of the current macro environment, Erin, and I think that's a good segue because, oil and gas, right? It is one of the best performers last year, one of the best performers this year. And, it definitely doesn't hit on the E, but, I think the demand for oil and gas right now, and the reason it's so high, obviously, is this humanitarian crisis in Ukraine, right? And so, what's your view on investing in oil and gas, whether, at PIMCO or personally, in relation to some of these, ESG concerns?
Well, I think the biggest, it's a little bit of a challenge for ESG. We had talked about this actually at the Ocean Conservancy, which I'm a board member, which is that because of ESG constraints and concerns, the E concerns, over the last 5-10 years, we haven't seen, particularly in the U.S., U.S. shale companies investing in new capacity and investing in new exploration. They've really were hurt pretty significantly for overcapacity, oversupply, over the last 10 years. And as a result of that, they've ratcheted back their CapEx significantly, really focused on returning capital to shareholder, on corporate discipline, on CapEx discipline. And so as a result of that, when we came into this supply shock, this supply crisis because of the conflict in Russia and Ukraine, the energy companies were underinvested, at least couldn't increase capacity, and also refused to increase capacity because they said, look, we've been rewarded by our shareholders for the last few years by being disciplined, by being very focused on returning capital to shareholders and on not making the same mistakes as we made, a decade ago. And as a result of that, we're not going to increase capacity into this crisis. We're going to hold our ground and, do what our shareholders expect us to do and what we've delineated we're going to do. And as a result of that, we've seen now, in part to other reasons, obviously, we've seen, prices spike in oil, and it's now actually returning a lot of capital, a lot of money, and a lot of profitability to energy and gas and companies broadly. And so it's a little bit of a challenge, which is that I think that for the future of finance and for the future of sort of the health of our economy, we want to over time slowly reduce our dependence on oil, on gas, and move towards friendlier environmental sources of energy. But if you do it too quickly, like Germany has learned by closing down its nuclear reactors, you could end up in a situation where you actually, help to provide more capital to the companies in the industry that you're trying to move away from. So I think it's a really, the last 12 months, the last 18 months have really shown a light on how it's really important that to get this right and to have a sustainable sort of move away from, traditional fossil fuels and into more environmentally friendly sources of energy. We need to do it in a very structured fashion to make sure that we're not exposing ourselves to exogenous risks along the way.
Awesome. No, that's a great answer and a great take. So I would like to open it up to the group. If there are any questions, feel free to toss them in the chat or raise your hand. I have a laundry list here for Erin, obviously. We could go in so many different directions right now. So does anybody have a question at the moment? Okay, go ahead, Maz. Yeah.
Thanks again. I just want to pivot a little bit, Erin, and talk about your career path. Obviously, you've been in an investing and research capacity through different roles, but you've also moved between the buy side and the sell side with banks and asset managers. Just wondering if you could talk a little bit about what the difference in your experience between both has been, and especially from the lens of us as students who might be looking at either starting or pivoting our careers. Where do you think, what are really the pros and cons, between the two sides of the coin?
So I'll be really honest in my answer. And I think the answer does differ a little bit in terms of if you're an undergrad coming out with no experience or a graduate student coming out with years of experience or some experience, at least in finance. I think that asset managers and hedge funds, in particular hedge funds, are really tend to be not great sort of breeding grounds for young people coming out without experience from finance. It tends to comprise of very senior people with 20 plus years of experience under their belts, very lean in terms of the organization and structure, and quite frankly, not well positioned to be able to train young talent coming out of undergraduate or graduate programs if they don't have years of experience, having, prior to their MBA program. Banks are completely set up for this. They are, well-oiled machines where you come out of your undergraduate or your MBA program, you go into a training program, you have teams of people around you that are really there purely to support you, to support your growth, to make sure that you're moving up, sort of this predefined path from analyst to associate to VP, and where the incentive sort of the entire system is built around incentivizing managers to train, develop, and promote that talent. Whereas as a portfolio manager, I will tell you, like, very little of my year-end review to zero of my year-end review is if I'm being completely frank, is how I develop talent, right? Especially very junior talent. That's not how I'm compensated. I'm compensated on how much money I make. For the firm, for my clients, for the fund, where the incentive scheme is very different at investment banks. So I think that particularly for undergrads, but probably for most MBAs, unless you have vast years of experience behind you, going into a banking or into an investment bank with an established program is probably your best bet to get your training wheels, spend a couple of years there, and then pivot to the buy side. Yes, like the buy side is seen as, in some ways is often seen as sort of the golden ticket because you can make, a lot of money and really do well and define yourself in your career that way. But if you don't have the proper training before you sort of make that leap to the buy side, you end up getting stuck. And I've seen people that have come from out of undergrad or out of MBA programs, and some of them felt like they got the best job ever because they were working at a top tier hedge fund, and they're in this great seat and have all this exposure. And 5 years later, they're still doing the same thing that they did their first year, versus someone who went into a banking program, sort of did the grunt work for a couple of years, sort of did the sort of heavy lifting, but grew pretty significantly, and they're far outpacing that person who started at the hedge fund 5 years later, both in terms of compensation, role, responsibilities, as well as future growth like prospects. So it's something that I know a lot of people don't like to hear because they get this great offer and they think it's amazing, but I think you just do the hard work. You sort of do the established path where people are really like focused on making you great, on making and developing you. And that sets up for a much better career, I think, going forward.
Awesome. Thank you.
I guess we can stay on the career topic for a bit here too. Can you talk a little bit about, we know that Wall Street historically has been a very male-dominated industry. And when you graduated undergrad and went into that, can you talk about your time there and how did you differentiate and how did you climb the ranks as you did? And what were some of the challenges, especially being a woman in that environment?
Yeah, so I graduated in 2001 from Georgetown. It was, obviously in the middle of the global financial crisis, or not the global financial, in 2001. So like the market, like sold off pretty significantly. I remember like my first year there, like people were getting laid off from my analyst class. Like it was pretty depressing. And by the time my analyst class, I think, started with 150 people, and by the time I ended 3 years later, because it was investment banking, there were 3 of us left, or 3 of us that got promoted. There were some other people left, but they didn't get promoted. So it was like pretty harsh time to be graduating, in 2000, 2001, 2002, and it wasn't much better a couple of years later in 2008, 2009. So I think that people who like stuck with it, who kept their head to the ground, who just worked really hard, did well. But, I think I've never felt, and this is, I've never felt discriminated. It's still very much a male-dominated industry. I've never felt discriminated against because I'm a woman. I've traveled all around the world, meeting with heads of central banks, ministers of finance. I'm always the only woman, and I'm always the one that they remember year after year because I'm the only woman. So they remember me. I actually think it's an advantage in some ways. And if you think about it as a disadvantage, you're probably not going to survive in the industry. But if you just think about like what you bring to the table that's differentiated, whether you're a man or a woman, I don't think we're a performance-driven culture and a performance-driven industry. Performance speaks a lot louder than what your skin color is, what your gender is, what your sexuality is. Deliver results. And I can tell you, Steve Cohen, because I worked for him for several years, didn't care what I looked like. He didn't care what my voice sounded like. All he cared about is how much money I made for him. And I think many people in that industry, in our industry, that's what they're focused on. They care about performance and results. That said, it's a hard charging industry, and I think it does take, it takes its thick skin. And I think a lot of people, whether you're man or a woman, like that's not an environment that people want to be in. And particularly as you get older, like, and you have other considerations like family, it is hard. Like it can be hard. I have a 1-year-old son. He's the love of my life. I had a kid late in life,
Congrats.
But he's the love of my life, and he's the best thing that I have in my life. But I can set my own hours. I can come home when I want to. I log back in from home. It's a very flexible career for me, and so I do think it's very manageable. But I think you have to, you have to work hard. You have to be tough, and you have to, be able to deal with very stressful environments. And I don't think that's harder or easier for men versus women. I think it's tough no matter who you are.
Right. Yeah. Incredible answer. And I don't think that this flexibility that you have now came overnight. Many long hours and long nights. I'm sure I'm kind of in that right now. But anyway, I wanted to talk about, we have about 5 more minutes, and I'd be remiss if I didn't pick your brain on Fed policy and, whether or not you believe they can engineer a soft landing. And for those on the call that don't know what that is, it's the ability to raise interest rates to tame inflation without creating a recession. So please, give us your view on that.
So I will say that I have the benefit. I sit on the investment committee at PIMCO, and there's about 10 of us on it. And Ben Bernanke is the the chair of our global advisory board. So we have frequent calls with him. So I also have the benefit of talking to him regularly about his view. His view hasn't always been right, but at least it's quite insightful in terms of how the Fed is, engineering or trying to engineer this soft landing. I think that there's a very narrow landing strip for the Fed. That's not to say it can't be done. I do think that the Fed, by taking action sooner rather than later and being aggressive in terms of front loading those hikes, by doing 50 basis points at a clip over the next 2 meetings, which I'm expecting, is the right answer. But you also have to remember that the Fed is using what I like in a blunt force instrument to deal with a very nuanced problem that they're not equipped to deal with. The tools that the Fed have is to raise interest rates, to lower interest rates, and to do quantitative tightening. And there's a couple of other things that they can do, but the challenges that the economy facing right now are not monetary problems. They're not too much liquidity in the system. Inflation is being driven by supply chain constraints, and the Fed can deal with demand side problems. They can't really deal with supply side problems. And so that challenge, really can be better addressed by Congress, but that, the likelihood of that happening is pretty limited right now. So I think that if the Fed is able to sort of navigate this gentle, sort of soft landing, I think in part it's going to be by luck and by chance rather than, pure sort of expertise on their hand. And that's not in any way to be dismissive of the Fed. I just don't think that this is a problem that the Fed has the tools to be able to deal with. That said, the balance sheets for the economy right now are pretty clean. Like household balance sheets are quite robust. Corporate balance sheets look pretty good, except for some pockets of the CCC market. The leverage that's been built up in the system is largely on the government side, not on the household or the corporate side. And so we're not going to have a balance sheet recession likely, which is historically what we've seen in other sort of recessionary times. So that does give me some hope that if we start to see some amelioration of these supply chain constraints that have been spilled over from the pandemic and exacerbated by the war in Ukraine and Russia, that we actually could see a soft landing, albeit with a lot of volatility between now and then.
Right. Yeah, it's such an interesting time. We have, easing COVID restrictions. So there is demand for consumers to get out there. They have been saving so much money over the duration of the pandemic. And so it doesn't align with some of the previous recessionary periods. Yeah, very interesting. Look, we're at time, Erin. I think we could talk all day. And I know Maz would like to pick your brain with a few questions too, if we had some more time. So, but I really, really appreciate it. And thank you so much for coming on. And hopefully maybe next year, if you're in DC for whatever reason, we could get you to come on campus.